Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today we're building your financial toolkit for tax literacy. If taxes feel like a yearly fire drill, you're leaving profit on the table. Think of tax knowledge as a profit lever. The right structure, systems, and timing turn compliance into cash flow. My goal is to make this practical and actionable for entrepreneurs and high earners. Grab your coffee. In the next half hour, we'll cover strategies you can use this quarter. Your toolkit has 4 pillars: entity choice, clean bookkeeping, payroll, and forecasting. Entity choice determines how your profit is taxed. Bookkeeping turns chaos into clarity, lowering prep time and revealing planning opportunities. Payroll sets rules for owner compensation and employment taxes. Forecasting ties it together so you can decide when to spend, when to save, and how to fund estimates. When pillars align, you avoid penalties, keep lenders happy, and make strategic decisions with numbers you trust. Let's demystify entities. An LLC is a wrapper. By default, it's taxed as a sole proprietorship or partnership. You can elect S-corporation status to reduce self-employment tax with a reasonable salary. A C-corporation pays its own tax, enabling fringe benefits and reinvestment, but watch for double taxation on dividends. Fit matters. Early service businesses start as LLCs, mature into S-corp when profits stabilize, and adopt C-corp for venture capital, QSBS potential, or equity compensation plans. Reasonable compensation is the S-corp linchpin. The IRS expects owners who materially participate to take a market-based salary before distributions. Document your analysis: duties, time, experience, geography, and third-party wage data. Run payroll on schedule, remit deposits on time, and file quarterly forms. Pay too little, and you risk reclassification. Pay too much, and you erase savings. A thoughtful salary plus distributions often optimizes total payroll and income tax. Clean books equal clean taxes. Separate business and personal finances, dedicated bank and credit accounts are non-negotiable. Build a chart of accounts tailored to your industry so expenses fall into consistent buckets. Choose cash or accrual deliberately. Accrual offers better management reporting, but cash can simplify taxes. Close monthly, reconcile accounts, review trends, and flag anomalies. Accurate financials speed your return, prevent missed deductions, and give confidence when a lender, investor, or auditor asks questions. Estimated taxes are a cash flow rhythm. Individuals pay quarterly based on expected income. Safe harbors help you avoid penalties. Pay 100% of last year's tax, 110% if AGI exceeded $150,000, or 90% of the current year's liability. Build reserves with every deposit. Skim a fixed percentage into a tax account. Align estimates with seasonality, and revisit after big wins or slowdowns. When in doubt, run a quick projection and adjust early. Use a simple deduction filter. Is it ordinary and necessary for your trade or business? If yes, track it and substantiate it. Keep receipts, invoices, and proof of payment. Note business purpose on travel and meals. For meals, generally 50% is deductible when business is discussed. Entertainment is not. For home office, qualify with exclusive and regular business use, then choose simplified square foot or actual expense allocation. Good records mean confidence at tax time and credibility under examination. Vehicles require special care. You can deduct either standard mileage or actual expenses. Pick the method that yields the larger deduction over time. Mileage demands a contemporaneous log with date, purpose, start, and end miles. Actual expense requires tracking fuel, maintenance, insurance, lease, or depreciation, and allocating business percentage. Travel must be business motivated, with primary purpose work related. Keep agendas, itineraries, and receipts. For mixed trips, allocate carefully. Remember, lavish or extravagant costs aren't deductible just because business occurred. Depreciation accelerates deductions for equipment, furniture, and certain vehicles. Section 179 lets you expense qualifying assets up to annual limits, subject to taxable income and phase-outs. Bonus depreciation allows a large first-year write-off for new and used assets with eligible recovery periods, but phase-down schedules change, so check current law. Strategy matters. Section 179 can target specific assets. Bonus applies broadly. Time purchases before year-end only if they make business sense. Consider state conformity and long-term income needs before front-loading deductions. Owner benefits can be powerful when structured correctly. Deduct health insurance premiums for owners when eligibility rules are met, and pair high deductible plans with health savings accounts for triple tax advantages. Use an accountable plan to reimburse employees and owners for business expenses with receipts, keeping reimbursements off payroll and off income. The Augusta rule allows renting your home to your business for up to 14 days per year, with income excluded under IRC 288G. But document fair rental value and business purpose. Retirement plans turn profit into deductions and future wealth. A SEP IRA is simple and flexible, but requires proportional employer contributions for eligible staff. A solo 401k lets owner-operators make employee deferrals plus employer profit sharing, often yielding higher limits at modest income. Add a cash balance plan to layer defined benefit deductions for very high earners, coordinated with a 401k. The right design depends on age, payroll, and hiring plans. Always model contributions, staff costs, and funding commitments before adopting. Section 199A, the qualified business income deduction, can deliver up to a 20% deduction on pass-through profits. Eligibility depends on taxable income, W-2 wages, and qualified property, with phase-outs for specified service trades like health, law, consulting, and financial services. Planning levers include managing taxable income, paying appropriate W-2 wages, and separating non-SSTB activities when legitimate. Don't chase the deduction blindly. Sometimes retirement contributions or entity changes generate better overall outcomes. Maintain solid payroll records and track UBIA of qualified property. Credits reduce tax dollar for dollar. The R&D credit isn't just for labs. Software, process improvements, and engineering often qualify, and startups can use it to offset payroll tax. Energy incentives can reward commercial solar, EV charging, efficient buildings, or clean vehicles, but documentation and prevailing wage rules matter. The Work Opportunity Tax Credit offers savings for hiring from targeted groups when screening and certification are done timely. Credits require precise records and forms. Coordinated planning prevents double dipping with deductions. Timing is a superpower. Bunch deductions like charity or medical into 1 year to clear thresholds. Defer or accelerate revenue using legitimate methods. Billing timing, deposits, or accrual estimates consistent with your accounting method. Installment sales can spread gains and manage brackets. Harvest capital losses to offset gains, or harvest gains in low-income years. Opportunity zones can defer and reduce certain capital gains when you reinvest timely and meet holding periods, but they're investments first. Underwrite the deal, not just the tax break. Plan exits years ahead. Track stock basis meticulously. Without basis, you can't substantiate tax-free returns of capital or loss. In asset versus stock sales, buyers prefer assets for depreciation. Sellers often prefer stock for capital gain treatment. Negotiate price accordingly. Earnouts create timing and character traps. Model scenarios before signing. Qualified small business stock under Section 1202 can exclude significant gains if you meet C Corp status, gross asset limits, original issuance, and 5-year holding. QSBS requires early, intentional planning. Operate in multiple states. Nexus can be triggered by employees, inventory, sales volume, or remote workers. Register where required, file income and franchise returns, and collect sales tax when applicable. Track sourcing rules. Market versus cost of performance can change where revenue lands. The federal SALT cap limits itemized state tax deductions, but many states offer a pass-through entity tax election that shifts state income tax to the business level, restoring deductibility federally. Run models before electing, and watch credits for taxes paid. Audit readiness is mostly discipline. Keep a written accountable plan, mileage logs, travel agendas, and receipts attached to transactions. Retain records for at least 3 years after filing, longer for assets and payroll. A modern tech stack makes this easy. Cloud accounting, integrated payroll, receipt capture, mileage tracking, and forecasting dashboards. Common mistakes I see: commingling funds, missing estimates, late payroll deposits, failing to track S-Corp basis, hobby loss risk from weak documentation, and sloppy auto or home office claims. Case Study 1. A single-member LLC nets $250,000. We elect S-Corp status effective January 1st. After a compensation study, the owner takes a $100,000 salary and $150,000 in distributions. Payroll taxes apply to the salary, not the distributions, saving roughly $15,000 to $20,000 in self-employment tax while staying within reasonable compensation norms. We implement monthly closes, set aside 30% for taxes, and adopt an accountable plan. Cash flow steadies, audit risk drops, and the owner finally pays themselves predictably. Case Study 2. A consultant earns $600,000. We set a solo 401k with max deferral and profit sharing, then add a cash balance plan creating $150,000 plus of deductions. We also use the Augusta rule for quarterly meetings at the owner's home with documented fair rent, agendas, and minutes. Today we covered entities, clean books, estimates, deductions, depreciation, owner benefits, retirement plans, QBI, credits, timing moves, multi-state and SALT, audit readiness, tech, and exit planning. Next steps: run a mid-year projection, upgrade documentation, and bring in a pro before year-end. Thanks for listening to Tax Smarts Unlocked.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.